All right, so welcome everyone. My name is Julie Shields-Rutina, and I'm the Director of College Planning, Education, and Training at MEFA. And thank you for joining us for this MEFA webinar that is going to be about the updates on the income-driven repayment plan for the federal student loan borrowers and Parent Plus loan borrowers. A hot topic. I know a lot of you are interested in this, and so we're so happy to be able to provide this today. I'll also share that my colleagues, Sean Morrissey and Stephanie Wells, are with me today. And I'm going to give a few logistics, and then I will introduce our very much of an expert presenter. All right. So a few of the logistics are that I am recording this so that tomorrow we will send you a copy of the recording and of the slides. As we go along, if you have questions, especially burning questions, because I know that Betsy will cover so much, put your questions in the Q&A section. And that way we have people behind the scenes who can help answer as well. If you need a live transcript, press the closed captioning CC button. And I think one person at least is already taking advantage of that. And again, if you need to leave the webinar, then you can do so, and we will be following up with you. I think most of you know, but MEFA is a state authority that was created in 1982, and we help families plan, save, and pay for college. And we share all kinds of great information about the college going process, and in this case, about student loans for both families and school counselors and everyone who works with students and former students. So I don't want to prolong this anymore because I want to introduce our great presenter today, Betsy Mayotte, who is the president and founder of the Institute of Student Loan Advisors, TISLA. Let me give a quick introduction, but just to say that we'll make it quick because I know that Betsy has a lot to share. So Betsy, again, is the president and founder of TISLA. She's been working in the student loan industry doing compliance and advocacy work for over 20 years and has helped thousands of borrowers with their student loans. Betsy has served as a primary negotiator for several federal Title IV negotiated rulemaking sessions on topics such as the use of student loans at foreign schools, loan rehabilitation and borrower defense to repayment. In addition, Betsy frequently conducts regulatory trainings for the higher education financing industry, both in the Kingdom, Canada, Australia, and New Zealand. She's regularly quoted in the media on student loan issues, including the Washington Post, the New York Times, the Wall Street Journal, and the Boston Globe. And in fact, there are so many things going on in the loan industry that those quotes have been more frequent of late. And she was recently featured in Money Magazine as one of the top 50 influential change makers in America's finances. She was born and raised in Lowell and currently lives in Plymouth, Massachusetts. So with that, Betsy, I'm going to turn it over to you, and I'm sure you can also introduce Pat from your wonderful TISLA organization.
I sure can. Thank you for that introduction. Let me just get the presentation up there. And I have a lot of screens open. Okay. And I'm going to shut my camera off because my face will do absolutely nothing to contribute to this. Okay, so with me today, I have my senior student loan advisor, Pat Torkelson. She's going to be working the Q&A panel for you. A word about the Q&A. We've got an awesomely big group today, which I love to see. But the problem with that is sometimes the questions can get a little overwhelming and repetitive. So I want to put in place a couple ground rules for the questions. Let me just say, first off, we love answering questions. And if you have some, you can post them in the Q&A panel on your screen, and Pat will answer as many of them as she can throughout the presentation. And if there's any question that she thinks might be really good for the whole group to hear, every once in a while I'm going to take a breath and she'll feed that to me. Now, to make sure we can answer as many questions as possible, first ground rule: hold off on your question until I've covered the topic. If I'm doing my job right, I will answer that question for you along the way. So again, I know people are really anxious for their personal questions, but please don't ask it until we cover that topic. We will be hanging out for a few minutes at the end to cover any sort of stragglers that might be left over. The second thing is, please don't ask any detailed or personal questions. This isn't the forum for that. For one thing, it's public. And you don't necessarily need everybody on here knowing your business, so to speak. My organization, TISLA, we're a nonprofit who was founded to offer free, expert, and neutral student loan advice. So if after this presentation is over, you do still have a question and it's very personal and detailed in nature, I encourage you to go to our website, which is freestudentloanadvice.org, and we'll throw that up in the chat panel. It's also on the slides. Check out the plain English language information we have about these topics on our website. And then if you still have a question, you can go to our contact page and using the TISLA email, send us that detailed question that you want to ask us. And we answer the majority of the questions within a business day, and we're happy to do it. That's about it. So again, hold off on your question until we've covered the topic. See if I answer it for you along the way, and withhold your personal details because, again, this is a public forum. So with that said, we're going to cover sort of a potpourri of things today. What they all have in common is student loans and student loan forgiveness. I'm going to start off, even though this wasn't really in the advertisement of the session, but I feel like it's an elephant in the room and it's something we get questions about a lot, which is the Biden-Harris debt relief, like what it is, where it's at, so on and so forth. And then I'm going to get into the meat of the session, which is about the temporary one-time income-driven plan waiver, how that works, and especially how it dovetails with the recently ended public service loan forgiveness waiver, and how it essentially, for the most part, is kind of a backdoor extension to that waiver, which is awesome. And then if we have time, I'm going to talk about some upcoming permanent changes to the public service loan forgiveness program that will be effective. One of them is effective now. The rest will be effective on July 1st. So I just want to talk a little bit of background about all these waivers. So as Julie mentioned in my introduction, I've been working in the student loan industry since the earth cooled. And I got to tell you, the last 3 years in the student loan industry has been bananas. I've never seen anything like this. I've seen multiple once-in-a-lifetime scenarios, one of those being the Biden-Harris debt relief, another one being the public service loan forgiveness waiver. Stuff like this has never, ever happened before, and quite honestly, will almost certainly never, ever happen again. So why are they happening now? Well, it's sort of a perfect alignment of the stars. Now, as everybody on this call knows, we don't have a king. We have a president, and the president is bound by laws just like the rest of us are. And the sort of the overarching piece of law that that is relevant to this part of the discussion is the fact that, as a general rule, the president of the United States can't do anything that's contrary to federal law. So that's why we've never seen in the past a scenario where a president has said, all right, we're going to loosen up on the public service loan forgiveness rules, because he can't do that, because the majority of the public service loan forgiveness rules are written into federal law and are set by Congress. Now, there is a piece of legislation called the HEROES Act. And the HEROES Act, when it was enacted, part of it said that in situations of national emergency, that the president of the United States can do things, and I'm obviously paraphrasing here, can do things during the national emergency and during the national emergency only that are contrary to federal law. Now, In short, what I'm saying here is we have COVID to thank for all of these for the most part. Because if it wasn't for the national emergency that was created by COVID, the current Department of Education and the President of the United States would not be able to do these temporary waivers, nor would they be able. This is the argument. The HEROES Act and the national emergency is the primary argument that the President of the United States is using to justify the Biden-Harris debt relief. This also explains why they're only temporary. There are a couple things that were in the PSLF waiver that are going to be made permanent because they weren't in law. They were only listed in regulation. And the Department of Ed has been very busy over the past year and a half doing what it needed to do to make changes to those regulations permanent. But again, for the most part, the PSLF waiver and what we're going to talk about with the income-driven plan waiver is written into federal law, so only Congress can make those changes permanent. Are they at risk for reversal? Well, as we've seen, the Biden-Harris debt relief is being challenged in court, and at this point, it's at the Supreme Court level. For those reasons, the PSLF waiver, somebody could have also chosen to challenge that, saying that it was an overreach of the president's powers under the HEROES Act and during the national emergency, and somebody could also choose to do that for the IDR waiver. Well, nobody that we saw filed any lawsuits against to challenge the PSLF waiver, so that's safe. And I haven't even heard any chatter or saber rattling, so to speak, about the income-driven plan waiver. So I feel like the risk for that is also very, very small. But as we've seen, and as I mentioned, there were multiple lawsuits filed against the Biden-Harris debt relief. And I'm just going to really do a quick overview of what I'm talking about, the Biden-Harris debt relief, the eligibility for it, and then I'll talk really quick about where it stands as far as the court goes. So the Biden-Harris debt relief is President Biden's fulfilling his campaign promise to offer student loan forgiveness. Now, to be fair, he's done this in many other ways over the last 2 years, public service loan forgiveness waiver, the IDR waiver that we're talking about. He's done a lot to open up discharge for the most vulnerable borrowers to make it easy for them to get loan discharges. I'm talking about borrowers that were defrauded by their schools or borrowers that are considered permanently disabled. But sort of the big whammy is what they're calling this Biden-Harris debt relief. Now, in order to be potentially eligible for this, if this does make it through the court challenges, you do have to have a Department of Education held federal student loan. That's a Stafford loan, Graduate Plus, Parent Plus, or a consolidation. And it has to be either a federal direct loan, a defaulted loan, or a FEL or a Perkins loan that was consolidated prior to September 29th of 2022. If you have a federal family education loan program loan or a Perkins loan that was not consolidated before that date and is not held directly by the Department of Education, I'm afraid you're not eligible for this debt relief. Although the Department of Ed has expressed the desire to try to find a way to loop those loans in. If you do have a FEL or a Perkins, or if you're just not sure what kind of loan you have, here's an easy way to figure out whether the loan's potentially eligible for this. Has this loan been eligible for the COVID pause? Meaning you've been enjoying a 0% interest rate since March of 2020, and you've enjoyed not having any payments due. You haven't received a bill on your loan since March of 2020. If it falls under that category, it is potentially eligible, assuming you meet the other requirements for the Biden-Harris debt relief. If you've been getting bills or you've been getting charged interest, it is not eligible for the Biden-Harris debt relief. Private loans were never eligible, even private loans that were previously federal loans that had been refinanced into the private loan program. Unfortunately, there's no take-backsies on that, and those loans are not eligible. The other prong to this eligibility is income. If you had an adjusted gross income as a single person of less than $125,000 in either the 2020 or the 2021 tax year, then you are eligible for this debt relief. They are not looking at 2022, and they're only looking at either or 2020 or 2021. So if in 2020 your AGI was $45 million, but in 2021 it was 120,000, you are eligible for this debt relief. For married couples or head of household, that income cap is adjusted gross income of 250,000. The only sort of subset of that is someone who was in school, enrolled in school, an undergraduate program between July 1st of 2021 and June 30th of 2022. And you were under 24 years old or otherwise considered a dependent student for financial aid purposes. Tax purposes aren't relevant. We're talking financial aid purposes. In that scenario, your qualifications will be based on your parents' income, not on your income. And then the last thing I want to mention about the eligibility is the loan had to have been at least have one disbursement sent to the school by June 30th of 2022. Any loans that were dispersed after June 30th of 2022 are not eligible and they cannot be made eligible. Now, how much is forgiven? Well, all borrowers are eligible. All borrowers that fit the categories that I described are eligible for up to $10,000 in loan forgiveness. Now, if at any point in your academic career, whether it overlapped you taking out loans or not, you received a Pell Grant, that forgiveness amount goes up to $20,000. If you're not sure if you ever received a Pell Grant, you can log on to studentaid.gov, which is the Department of Education's website, and it will tell you, as long as you got the Pell Grant after 1994, it'll be listed on that website. If you got a Pell Grant before 94, it won't be on the website, but they will have knowledge of it and give you your $20,000 eligibility. You just don't have a way to look it up. Now, in most cases, if you owe less than the amount of forgiveness you're eligible for, you will not get a refund. And I'm going to give you a couple of examples of that in a minute. The only exception to that is if the reason you owe less than the amount of forgiveness you're eligible for is because you made payments during COVID. In that scenario, you will potentially get a refund. And again, I'm going to show you some examples of that in just one second. The eligibility for this forgiveness is on a borrower basis, not a family basis. So, you know, if let's say the Duggars, they're 19 kids and counting, every single one of them received a student loan, including Michelle and Jim, and every single one of them met the income requirements, then every single one of them would be eligible for the $10,000 or $20,000 in loan forgiveness, all 21 of them. So again, it's per borrower, not per family. So as I mentioned, as far as refunds go, if you paid during COVID and the loan was eligible for the COVID pause, you can always request a refund of those payments, which is any payment made after March 13th of 2020. Now, if you still have a balance and you paid your loan below what you'd get in forgiveness during COVID, you're going to automatically get that refund. If you paid your loan off during COVID and it was COVID eligible, you do have to ask for a refund now, so they open the loan back up and therefore make it eligible for any potential forgiveness that you're eligible for. If the loans aren't eligible for COVID, they're not eligible for refunds. They're also not eligible to be opened back up. If the reason the loan is paid in full is because you either consolidated or refinanced it, that's it. No take backsies, no refunds. You cannot open the loan back up, I'm afraid. Now let's look at the examples just to try to hammer this home, because we get a lot of questions around the refunds because it can be a little bit confusing. Let's talk about George. George has all direct loans, which of course are COVID eligible loans. When the COVID pause began March 13th of 2020, he owed 23 grand. Now, during the pause, he's been taking advantage of the 0% interest rate, and he's paid about $6,000 in the last 3 years. So right now his balance is $17,000. Excuse me. Now, George did get a Pell Grant during his academic career, and he meets the income requirements. So he's eligible for 20 grand in debt relief. Once they apply that debt relief, he will get an automatic refund of $3,000. And that's because his balance is lower than the amount of forgiveness he's eligible for. And the reason it's lower is because he made payments during COVID. Now let's talk about Zeke. Zeke and George have pretty similar scenarios, except for a little bit of a difference. Zeke also has direct loans, which again are also eligible for the COVID pause. When the pause began on March 13th, Zeke owed only $17,000. Now during the pause, he hasn't made any payments, which is fine. He hasn't been due for any payments. Zeke also received a Pell Grant during his academic career, and he meets the income requirements. So he's also eligible for the 20 grand in debt relief. Once that's applied, assuming it gets through the courts, he will also have a zero balance, just like George, but he's not going to get a refund. And the reason he's not going to get a refund is because he was at 17 grand to start with and didn't make any payments during COVID that brought the balance down below his forgiveness level. Now, if the Biden-Harris debt relief does get approved by the Supreme Court, they will once again open the application, and the application will be super easy to find on studentaid.gov. If that time comes, it's just going to be a pop-up window as soon as you go to the website. In the meantime, you can actually go to that same website, and there's banners at the top of the page that you can click on, and it'll give you a place to sign up for email alerts. So if you want to know as soon as that application opens up again, you'll get an email alert for that. Now, there's about 8 million borrowers that actually won't have to apply at all. That's going to be a borrower who submitted a FAFSA or maybe submitted proof of income for an income-driven plan in 2020 or 2021. If you were one of those people, you would have already received an email giving you the opportunity to opt out of the forgiveness. Why would you want to opt out, you might ask? Well, there's a couple states, I believe we're down to 4, that are going to tax this forgiveness as income. It will not be taxed on the federal level, and it will not be taxed in the other states other than these 4. But for borrowers in those 4 states, some of them are either pursuing public service loan forgiveness, which isn't taxed, or perhaps they're receiving some sort of income-based benefit, such as a housing benefit, that this forgiveness would put them over the income threshold and they might lose their housing benefit. If you didn't get an email already saying that, giving you the opportunity to opt out, you are not one of the people that won't have to apply. And if and when the application opens back up, you're going to want to make sure that you do apply before the end of this year. Now, originally, before this got tangled up in the courts, when they announced it in August, their intention was for anybody that had applied by mid-November. Now, back then, we thought payments were going to resume in January. So the goal was to have anybody that applied by mid-November to have their forgiveness applied by January. Now, obviously, both of those thresholds have passed, but it gives us a sort of peek into what we can expect we might expect the timeline to be if and when this opens back up. And it appears like they feel like they're going to be able to process the majority of these within 6 weeks of the time they receive and approve the application for forgiveness. Now, the application itself could not be easier. You don't have to log in. You don't have to submit and upload any documents. You literally just have to put in your name, your social security number, and electronically sign a statement that under penalty of perjury, the information you're supplying is true, including verifying that you meet the income threshold. Now, unfortunately, sometimes the reason we can't have nice things is there's always going to be someone that tries to get around the system, so to speak. And the Department of Education, in addition to facilitating financial aid and student loan programs and, sort of all aspects of education in this country, they also are required to be a steward of, U.S. taxpayer funds. And that's what these are U.S. taxpayer funds. So in recognition of that, they have baked in some AI and algorithms into the process for forgiveness to try to identify people that may not have necessarily been telling the truth when they submitted the application. They also are going to randomly require about 5 million borrowers to go through a process that we're calling verification. If you get notified after you submit your application that you have been chosen to do income verification, you'll be required by March 31st of 2024 to submit proof of income, either through your tax return, a tax transcript, or if you weren't required to file taxes, a letter from the IRS verifying that you weren't required to file taxes. If you are chosen for verification and you choose not to submit it or don't submit it by March 31st, you can't get the Biden-Harris debt relief, and there's no appeal to it, and you will never be able to get it. Another question we get quite often is how they're going to apply the, do I have a choice of where they apply the money? The answer is no, but that's okay, because I think most borrowers will be pleased with how they're planning on applying it. The hierarchy is they're going to start with any defaulted loans. Then if you don't have any loans in default, they're going to look for the loan with the highest interest rate. If all your loans have the same interest rate, they're going to look for loans that don't have any type of interest subsidy allowed to them. And if all your loans are either subsidized or unsubsidized, they're going to go with the most recent loan. And then they go look at balance. And then once they apply the forgiveness, they're going to re-amortize your loan, which means that unless you're on a payment plan based on your income, your payment will probably go down. Now, where we're at with the lawsuits is, most of the lawsuits, there was a flurry of lawsuits that were filed when this was first introduced in August of last year, but most of them didn't have what we call standing, meaning that the people filing the lawsuits couldn't prove how they would be harmed by the plan, and that's a key to a lawsuit. There were a couple that sort of squeaked by on that, and in the end, long story short, the White House just sort of said, enough, we don't want to prolong this, we want to be able to allow our student loan borrowers to move forward, and they actually asked the Supreme Court to take a look at this, and they asked the Supreme Court to fast track it. So I've had a lot of people say, why is this taking so long? Well, in the realm of the Supreme Court, this whole thing is going remarkably fast. They're going to be hearing oral arguments around the 28th of this month, and they've stated that they'll issue, based on that, we can expect to get an opinion by the end of June. So I get asked a lot where I think this is going to land. Well, I'm a failed pessimist. So from that perspective, I'd like to think that the Supreme Court will see that A, the plaintiffs likely don't have standing, and B, whether the plaintiffs have standing or not, that this fits squarely under the intent of the HEROES Act. But, as I like to tell everybody, we should all be hoping for the best, but preparing for the worst. All right, any questions about that before I move on to the PSLF and IDR waivers, Pat?
No, you're good.
Okay, thank you. All right, so I wish I had 7 hours to go over all this stuff with you, but I don't. So some of this stuff I'm going to have to cover at a high level. I just want to remind you that we have all the information about these programs in gory detail, and I'd like to think plain English. That includes pretty extensive FAQ documents on our website. If you go, the public service loan forgiveness stuff is under our forgiveness page, and the income-driven plan stuff is on our repayment plan page. But just to get everybody on the same page, I want to do a quick overview of the rules for normal public service loan forgiveness rules. Now, PSLF gets kind of a bad rap for the rules being confusing, but if you take a step back and look at it from not even the 10,000 foot level, but the 5,000 foot level, it's actually fairly simple. And so, I always say, I use this slide all the time when I talk about PSLF, because I think if you remember this slide, you're going to be able to answer 85% of the questions you'll ever have about the normal public service loan forgiveness rules. So in order to get the balance of your loans forgiven under PSLF, you're required to make 120 eligible payments on an eligible loan while working for an eligible employer. Now I'm going to go over really quickly what all the eligibles mean. And again, the details of all those eligibles are on our website, also at studentaid.gov. But the point I'm trying to make with this slide is that in order for a month to count towards PSLF, you have to meet all three of these prongs. And they all have to happen at exactly the same time for a month to count. So you could be making an eligible payment on an eligible loan, but if you're not working for an eligible employer at the time, that month will never count under normal PSLF rules. And you can mix and match that and come up with the same answer. You could be working eligible employment, have eligible loans, but if you're not making an eligible payment, that month's not going to count under normal PSLF rules. Now, just to quickly go over, defining all these eligibles. An eligible loan is any federal direct loan. Doesn't matter when that loan was made. A direct loan can be a Stafford loan, a Graduate Plus loan, a Parent Plus loan, or a consolidation loan. An eligible payment under traditional PSLF rules is one that's made on time, one that's made under either a 10-year standard plan or any of the income-driven repayment plans, that's made on a direct loan while working eligible employment after 10/107 and while the loan's not in default. Also, under traditional PSLF rules, if you consolidate, they're not going to count any payments that you made prior to that consolidation. Now, that's a big piece of these waivers. So sort of put a pin in that in particular for a minute. Eligible employment is working full-time, which as of November 1st is now defined as 30 hours a week. Even if your employer considers 40 hours full-time, as of November 1st, as long as you're working 30, it counts for PSLF. And that you're working either for a government employer, that's federal, state, local, or tribal, any 501c3 nonprofit. And then there are some other nonprofits that count, but their primary reason for being has to be one of a list of about a dozen functions that include public education, public health, public library services, public legal aid, that kind of thing. You do have to be a direct employee. That means that if you're a contractor, unless your contracting company that you work for is in and of itself a PSLF eligible employer, which most of the time contractors are private employers, it's not going to count. If you are, working for yourself and have an individual contract with the company, so you get a 1099 in the mail, that does not count for PSLF purposes. But so you do have to be working directly for the eligible employer. Now, I tell you all of this so to help you understand why the waivers, what the difference in rules are for the waivers and what exactly the waivers waived. One other thing I want to mention is this COVID period. So since March 13th of 2020, on COVID eligible loans, all of these months have counted towards both PSLF as well as the income-driven plan forgiveness pieces. Now, for PSLF, you do still have to be working for an eligible employer for the month to count, but you shouldn't have been paying. If you're pursuing PSLF, you should not be paying during COVID. It's literally the same as throwing money and flushing it down the toilet. So if you have been paying during COVID and you've been working for an eligible employer and you've been pursuing PSLF, as soon as you get off this webinar, you should be calling your loan servicer and asking for that money back. And they will happily send you that money back fairly quickly. Okay, so let's talk about the waivers. So last October, so October of 2021, so I should say 2 Octobers ago, the Department of Education announced a temporary public service loan forgiveness waiver. And what that waiver did is it essentially wiped out a lot of the eligible payment rules that we just sort of skimmed over. So they were essentially counting as long as you submitted a PSLF form, so proof of some sort of PSLF eligible employment by October 31st, and if you didn't have direct loans, like if you had Fell or Perkins loans, that you consolidated into the direct loan program by 10/31 of 2022, that you could get credit for pretty much any payment, even if that payment had been made on a Fell loan, if it had been late, if it had been not under an income-driven repayment plan. If it had been prior to a consolidation, they were counting them all. And we've worked with a lot of borrowers that have received a lot of credits that they either thought they'd missed out on or shouldn't have been able to receive under traditional PSLF rules. So that waiver had a hard stop of October 31st. If you didn't raise your hand by October 31st, then you weren't going to be able to take advantage of that PSLF waiver. However, on October 25th, they made an announcement about giving us more information about something we'd already sort of heard chatter about, which was what they're calling the income-driven plan waiver or income-driven plan one-time adjustment. Now, the income-driven plans have their own forgiveness component baked in. So essentially, if you are on an income-driven plan for either 20 or 25 years, and that depends on your loan type and or which plan you're on, and the loan isn't paid off after being on an income-driven plan for the 20 or 25 years, then the government forgives the balance. Now, if you remember, you have to be on an income-driven plan under traditional PSLF rules for a month to count for PSLF. So what they're choosing to do is use this, and this is what they announced on October 25th, is they're choosing to use the income-driven plan waiver to essentially do a backdoor extension of the public service loan forgiveness waiver. And then there's actually even some additional benefits there. So I'm going to talk about those in a minute. But first, let's back up and do a little primer about what about the income-driven plan and the traditional rules for the income-driven plans. Now, there's technically 5 IDR plans, and they're all exactly the same except where they're different. All of them base the payment on your income and your family size. And by income, I'm talking, we call it discretionary income. And all the plans are a little bit different, but essentially they take their poverty level for your family size and subtract that, or subtract, in some plans, subtract 150% of that from your adjusted gross income. And that's the income amount that they're using in the calculation. All the income-driven plans require you to reapply on an annual basis. So you're assuming every year, assuming your income changes, your payment's going to change, and it can go up or it can go down depending on the change in your income. As I mentioned, if you're on an income-driven plan, any of the plans, and you can mix and match, you don't have to be on the same plan for the whole 20 or 25 years, but if you're on a plan for the 20 or 25 years, they do forgive the balance. It doesn't matter what you do for a living, or even if you're working for that matter. And it certainly doesn't matter who you're working for or how many hours a week that you work. Your employment isn't a factor here. Only your income is a factor. Now, under traditional IDR rules, if you consolidate, it does reset your IDR count. So if you had, say, 12 years of IDR payments under your belt, and then you consolidated outside of these waivers, your IDR count would go back to 0, and you'd still have 20 or 25 years in front of you. Now, the plans that we're talking about are called, we call it old IBR. That's has been around since 2009. Because we're not super creative in this industry, there's another one called new IBR, which has very different rules than old IBR does. Excuse me, there's the pay-as-you-earn program, there's the revised pay-as-you-earn program, and there's the income contingent repayment program. Now, ICR, I want to sort of pull that out for a minute. Parent Plus loans, which are eligible for PSLF, unfortunately, they're not eligible for any of the IDR plans unless they consolidate. If they consolidate, they then become eligible for the ICR plan, and that plan only. Now, we don't really have time to go into it in detail. We do have it described on our website, however. There is a loophole for Parent Plus loans that we call the double super secret consolidation loophole. And what that is, and it's completely legal, it's just not talked about, If you can consolidate your Parent Plus loan twice, and we explain how to do that again on our website, then it does open you up to the other income-driven plans. And that can be important because ICR, not all the time, but a lot of the times, ICR tends to be the more expensive plan than the others. Again, there are some exceptions to that. But if that's your situation, and especially someone who that plan might not be affordable, or you're trying to pay the least amount possible because you're pursuing public service loan forgiveness, it might be worth looking into the double super secret consolidation method. Now, getting back to the income-driven plan waiver. So the income-driven plan waiver is similar to the PSLF waiver in that they're going to be giving people credit for every month that they were in repayment. And in fact, some months that they were even in deferment or forbearance towards the 20 or 25 years needed for income-driven plan forgiveness, even if they weren't on an income-driven plan. Now this applies to the IDR waiver is going to be applied. You don't have to, I keep using the word apply, but you actually don't even have to apply for it. It's just going to happen. It's a one-time adjustment. We've never seen it before. We're never going to see it again. You don't have to call. Calling actually isn't even going to do any good. But if you have an eligible loan, once they do the adjustments, it's just going to happen. And it's going to apply to any Department of Education held or managed Stafford loan, Graduate Plus loan, Parent Plus loan, and any direct, that includes consolidations, and it includes consolidations where the consolidation has some FEL loans or Perkins loans or other federal loans in it, as long as you consolidate by May 1st of 2023. Now, if you already have all direct loans, you may not need to consolidate at all, especially if they've all been in repayment for the same amount of time. But if you have FEL loans or Perkins loans, you definitely want to consider consolidating by May 1st in order to get the value of this IDR adjustment. Again, if you're not sure if your loan is eligible for this, has it been eligible for COVID? If it's been eligible for COVID, meaning you haven't been billed for the last 3 years and you're enjoying a 0% interest rate, your loan is eligible for the IDR waiver, and you likely don't need to take any action. Now, here's where it becomes sort of a backdoor extension for 90% of the PSLF waiver as well. Now, under the idea, as I mentioned, under the IDR waiver, they are going to count any payments you made on a FEL or Perkins loan prior to consolidation, or any other loan for that matter, prior to consolidation, as long as you consolidate by May 1st. And they're going to apply that to both the income-driven plan forgiveness, the 20 or 25 years, as well as PSLF forgiveness, assuming that you were working full-time for a PSLF eligible employer during that month. Here's a big difference. For no good reason, they excluded Parent Plus loans from the PSLF waiver. However, they recently and pretty quietly announced that they are including Parent Plus loans in this IDR waiver. So here's the chance for our poor Parent Plus borrowers who weren't able to take advantage of the PSLF waiver to actually get PSLF as well as income-driven plan credit. Now, they're also going to count payments if they had been past due or not, or haven't paid enough. Doesn't matter what payment plan you were on. The only thing that won't count are periods of default. And again, for PSLF purposes, they won't count towards PSLF any payment made prior to October of 2007. Now, they're also going to count some periods of deferment and forbearance, but they're not going to count those until they actually implement the income-driven plan one-time adjustment. And I'll talk about the timing of that in a minute. Now, one thing that was not extended, so again, essentially the entire public service loan forgiveness waiver has been extended because of this IDR waiver. The two things that aren't, under the PSLF waiver, if in the past you'd received teacher loan forgiveness, normally you can't double dip. the time that you used to qualify for teacher loan forgiveness also towards PSLF, but they were allowing it during the PSLF waiver. That ship has sailed. It's sailed away forever. We will never see it on the horizon again. So unless you took advantage of that prior to 10/31 of 2022, you're not going to be able to do that. The other piece that's gone forever is public service loan forgiveness requires that you be working for an eligible employer, not only for every one of those 120 months, but also at the time that they process your forgiveness. Unless you hit the 120 by October 31st and had submitted your proof of at least some eligible employment by then, that piece is also gone forever. So if you don't hit 120 until after October 31st of 2022, make sure you stay at your PSLF eligible job until you actually get that forgiveness letter in the mail and your balance shows as 0. Now, what's unclear when they do the adjustment, what's unclear is how far back are they going to go towards the income-driven plan forgiveness. There's a couple different scenarios. They could go back, obviously they're only going to go back. The earliest they could go back is, however old your loans are. But let's say you had loans from the 1980s. Now, the first income-driven plan that ever existed was income contingent, and that was put into law in 1994. But very, very few people have used it over the years. The first widely used income-driven plan came into play in 2009, and that was what we call old IBR. The Department of Ed has not publicly said how far back they're going to go, so they could go back to the beginning of time. So if you have loans from the 80s, assuming that they're not already direct loans, but you make them a direct loan through consolidation by May 1st, you would get immediate forgiveness once they do the adjustment on your account. But again, we don't know yet how far back they're going to go. If you consolidate by May 1st, it will not reset the count. Now, I'm going to talk a lot more about this in a second, because to say there's been misinformation or contradicting information out there about this aspect of the IDR waiver is an understatement, and I'm going to address that more fully in a second. If you have loans that have different counts, so the most common example is, let's say you went to undergraduate school, you took out loans, you were in repayment on them for a while, and then you went to graduate school and took out more loans. So your undergraduate loans have been in repayment, say, for 35 months, and your graduate loans have been in repayment for 12 months. Under this waiver, and under this waiver only, if you consolidate by May 1st, once they do the income-driven plan adjustment, your consolidation will get credit for the higher count. So in the example I gave, you'd get the entire consolidation would get credit for the 35. That includes public service loan forgiveness, and that includes Parent Plus loans. Now, let me address the miscommunication that's been out there about this. We are very aware that some of the servicers have been saying the opposite. That the servicers have been saying that unless you consolidated by the end of the PSLF waiver, that your count would reset to 0 forever. Sometimes they're saying that for both the IDR as well as PSLF. Sometimes they're just saying it about PSLF. Sometimes they're just saying it about direct loans. We are very aware of this. We have spoken to the Department of Education on multiple occasions and have been reassured that that is not the case. Our understanding is that they will be coming out with some FAQs. I don't know when, hopefully sooner rather than later, that will further clarify this. Now, with that said, I also understand how this can cause, this getting different messaging can cause a lot of anxiety. So remember, you have until May 1st to consolidate to, if you have different counts. If you don't have different counts, you don't need to consolidate. You don't need to worry about it anyway, unless you have Fell or Perkins loans. But if you do have different counts and could stand to benefit from consolidation giving you the higher count, and you want something different than some lady on a webinar telling you that it's okay, I just want to reassure you, you have till May 1st, and Lord, we do hope that those FAQs come out well before May 1st. I also want to further clarify that the consolidation won't have to be complete by May 1st. You will have just had to have applied for consolidation, submitted a completed application by May 1st in order to get that higher count credit under this waiver. Now, this is not official, and everything almost everything I've told you at this point has been fact, other than maybe when we were talking about the Supreme Court stuff and I was sort of giving some speculation around that. But everything else I've told you here has been fact. The next thing that's about to come out of my mouth falls under rumor, innuendo, and speculation. I've been hearing some chatter that they may actually extend that May 1st deadline, but I have nothing even remotely concrete. So once you're comfortable enough with the information, again, if you're going to benefit from consolidating, if you're not going to benefit, there's no point in consolidating. I wouldn't drag your feet any longer because there's no guarantee they will extend that May 1st. And what I've heard is, to call it chatter may even be more substantial than what it is. But there's a chance. Now, for both the IDR waiver and public service loan forgiveness in general, and this applies even outside of the waivers, but if it turns out that once they apply your public service loan forgiveness payments and or once they do the income-driven plan adjustment and count the number of years you have under your belt towards income-driven repayment forgiveness, it turns out that not only do you have forgiveness, but that you've overpaid, they will automatically send you a refund. The only exception to that is if the overpayment happened before consolidation. So for example, let's say you consolidate tomorrow based on this webinar, and then you don't make any more payments because you don't need to, because you already have either the 10 years for PSLF or the 20 or 25 years for the income-driven plans, and they process it and they figure out, yep, you have forgiveness and you actually technically overpaid by 3 years. In that scenario, you wouldn't get a refund because all of that overpayment happened prior to the consolidation. But let's say you consolidated 3 years ago and you've made 3 years of payment since then, and they process all of this and it turns out you've overpaid by 3 years. In that case, you would get a refund. Before I do sort of a quick review and move forward, Pat, are there any questions you think I need to address?
No, Betsy.
Really? Wow. I just want to make sure I didn't make anybody nervous. I didn't say you couldn't ask questions in the beginning. I just asked people to hold off until I covered the thing. So, let's put Pat to work.
Betsy, there have been some.
Oh, all right. I just wanted to make sure you weren't just sitting there smoking cigars and I don't know, playing Tetris or something. Okay, so I understand I'm repeating myself, but this is stuff we get questions about all the time. So there is a method to my madness. So the following things are temporary exceptions through May 1st of 2023. Consolidation will not reset either the PSLF or the IDR count. Now, when I say that, it will initially reset the count. So don't freak out. When you first apply for consolidation, the first terribly scary thing that's going to happen is you're going to get a letter from Aid Advantage. Aid Advantage is the servicer that processes all the consolidations. And that letter is going to say, hey, are you sure you want to do this? Because if you do it, it's going to reset your PSLF and IDR count forever. Ignore it. I know it's terrifying, but ignore it. That letter is based on the traditional PSLF and IDR rules. Believe it or not, it takes the government forever to change the language on an official letter. And all this stuff was supposed to be for a very short window of time, not 3 years. So that's why they never got around to changing that letter. So that's the first terrifying thing that's going to happen. The second terrifying thing that's going to happen is once the consolidation's complete, if you hum along and log into your account to check your PSLF count and your income-driven plan count, it's going to say 0. And you're going to go, that Betsy, she gave us bad information. Well, no, I gave you the correct information because initially it's going to be zero because it's a fresh new loan. It's not until they process the income driven plan one-time adjustment will you see those counts reappear. And what's going to make that even more of a nail biter is that adjustment's not going to happen for a wicked long time. And I know I'm showing my Boston when I put it that way, but you know what they, if you look at the Department of Education's income driven plan one-time adjustment page, they intimate that for most people they won't see that adjustment till the summer of this summer. I have heard, when I'm going to say chatter again, but this is more substantial than the chatter I'm hearing about the potential extension of the May 1st date, that at best we're not going to see the adjustments done until this fall. Now, there are a couple lucky borrowers that they are doing the IDR adjustment for as we speak, but that's only borrowers where doing the adjustment would give them PSLF forgiveness immediately. And it's not even all of those. So again, it's going to be scary because first you're going to get the letter saying, hey, this is going to reset the count. And then you're going to see your consolidation and your count's going to be reset. And then you're going to wait and wait and wait and wait and wait. But it will happen. If you have loans that have different counts, it will get assigned to the higher count, assuming you consolidate by May 1st. And if you consolidated more than once, they're going to do a look back on all of those consolidations. So, you know, I have borrowers, especially with older FEL loans, that have consolidated more than once, and they're going to, again, look back before, they're going to look back prior to all of those consolidations. I already talked about the timing. We get a lot of questions about, well, should I pursue PSLF or the Biden-Harris debt relief or the IDR waiver? And I say, why not all three? For the most part, pursuing one does not exclude you or make you ineligible for the other. The only exception to that is my poor FEL borrowers. If you have FFEL loans and if you took your loans out prior to 2010, and you haven't consolidated since 2010, there's a chance you do have these FFEL loans. And again, these are loans that would not have been eligible for the COVID waiver. So you would have been getting billed and accruing interest over the last 3 years. You have to consolidate by May 1st in order to get credit for the IDR waiver or this sort of backdoor extension to the PSLF waiver. But doing so will exclude you from the Biden-Harris debt relief. And you can blame the lawsuit filed by what was it, Pat? 6 states, Missouri, Indiana, whoever else. It's because of them that unfortunate and silly rules in place. So if that describes your situation, you're going to have to figure out if you're going to get more bang from your buck for the Biden-Harris debt relief, if it even gets through SCOTUS, or the IDR or PSLF waiver. Okay, just really, really quick. I know we're at the end of our time. As I mentioned, there have been some permanent changes made to public service loan forgiveness. The vast majority of them will not be in place until July 1st of this year. One of those is they're getting rid of the piece of PSLF that says that if the payment's late, they don't count it. You can be late on a payment as long as you make the payment up later, they will still count it, and assuming you meet all the other PSLF eligible rules. Lump sums payments, that's been in place for a while, but they actually finally put it into the regulations. Lump sum payments will count in a limited way up to no more than 12 payments. No matter what, just to be clear, you can never get credit for more than 1 month at a time. But if your payment's $100 a month, and in January you pay $1,200 and then don't pay again for the next 12 months, that used to not count for PSLF, but now it will count for the most part for PSLF. As I mentioned, and this is already in place as of November 1st, full-time now means 30 hours a week, regardless of what your employer considers to be full-time. They also are, you may not have been aware of this, but for the most part, our poor adjunct professors have been sort of edged out of PSLF because of the way the regulatory language read, and because of the fact that most colleges and universities don't consider adjunct professors full-time, well, they have put a caveat in place in the regulations. So effective July 1st, there will be a way for adjuncts to qualify, assuming that they're teaching enough credits, regardless of whether their college or university considers them full-time or not. Going forward, they're also going to count periods of economic hardship deferment, military and cancer treatment deferment towards PSLF, assuming you are also working full-time, at least 30 hours a week for an eligible employer during those deferment periods. One thing I forgot to mention about the IDR waiver, and shame on me, I mean, I think I mentioned it, but I think I sort of glossed over it. They are going to count periods of deferment other than in-school deferment towards IDR forgiveness. For the most part, any deferment other than an in-school deferment prior to 2013 will be counted under the one-time adjustment. And for deferments after 2013, they're going to count economic hardship, military, cancer treatment deferment, and also if you've used what they consider to be an excessive amount of forbearance over the years, which means either 12 consecutive months or more than 36 cumulative months. For this one-time adjustment only, they are going to count that towards the income-driven plan waiver as well, which means it'll also count for PSLF. But again, that's just under these waivers. What else did I have?
Betsy, are you going to mention the new IDR plan?
I was not going to, but if we have time afterwards, I could talk about it. And I just want to be, in case we don't end up talking about it, I want to make it super clear. This is a proposed plan. This is not a done deal by any means at this point. But if we have time, then
Somebody was interested in that.
okay. Couple other changes that are coming up July 1st. Most periods of interest capitalization are going away forever, which is awesome. And then they made some other changes that are particularly helpful to some of our most vulnerable borrowers, such as those pursuing discharge because of permanent disability, if their school closed while they were attending, or if they were defrauded by their school. And we will, once those rules are in place, so, after July 1st, we will be updating our website with that language as well. Now, here's some resources for you. Studentaid.gov, the Department of Ed's website. Our website, of course, which is freestudentloanadvice.org. And then I've posted the links to the announcements about these waivers in particular, so you can read it for yourself. I'm going to see if there's any more questions about our content today. And then if Julie says okay, I will spend 37 seconds talking about the proposed revised repay plan.
And I am fine with that. I think we all are fine with that. Let me just see. I don't see any current questions. So,
Pat, is there anything you think I need to reiterate or say in a clearer way?
Don't think so. I
Okay.
mean, frankly, I know some people are confused, but those people, I really encourage you to go to our website, and there's a contact us button where you can send us questions directly, and that's often the best way to walk you through these. They're very complicated. Some of them are very complicated issues.
Okay. And make sure you use the TISLA email, not the Betsy email. The Betsy email can get lost in the day-to-day stuff. So, borrow questions should go directly to the TISLA email. If you have questions about TISLA as an organization, you can use the Betsy email. All right. So the revised repay plan. So about a little over a month ago, the Department of Education finally issued draft regulations, which is essentially a proposal to change the existing repay plan to a much more generous plan. Now, the public comment period for those proposed rules just ended last Friday, and they received tens of thousands of comments on it. Where it stands now is that they are required to read all those comments, and then at some point they're going to issue what's called a final rule. And they may very well make changes based on those comments. They're also getting a lot of negative pressure from members of Congress about the cost of this plan, which is why I'm emphasizing so much that this is just a draft. But if, and this is a big if, the plan was to be issued final rules the way it was written in the draft, what it would do is it would significantly lower the payment for a lot of borrowers by doing two things. Number one, instead of using 100 or 150% of the poverty level for the borrower's family size to be subtracted from their adjusted gross income, it would be 225%. So you'd be starting from a much smaller income level to begin with. The other thing it does is right now, all the income driven plans, once they've determined what your discretionary income is, they take either 10 or 15 or 20% of that, depending on the plan. And that's how they figure out what your monthly payment's going to be. Well, under this, for some borrowers, it would be 5%, and that's borrowers with undergraduate loans. And for borrowers with graduate loans, it would be 10%. And for borrowers with a mix, it would be 7.5%. So it also not only lowers the income amount they're starting with from in the first place, they're also lowering the amount that they're going to take from that income amount to be your payment. The other thing this revised repay plan would do is if you only ever borrowed in the first place less than $12,000, and you've been on the revised repay plan, which doesn't exist yet, but you get on the revised repay plan and you're on it for 10 years, and you still have a balance after the 10 years, then they're going to forgive it after 10 instead of after 20 or 25. But that's only if you only ever borrowed 12 grand to begin with. So if you borrowed 50, but now you've paid it down to 12, this wouldn't apply to you the way this draft rule is written. It does exclude Parent Plus. From my read, Parent Plus loans would still be able to do the double super secret consolidation and be able to get into this plan. But again, that's based on where the draft rules read. And this plan could change significantly, or it might not change at all by the time we get the draft rules to come out. Now, the next question becomes, well, when are the final rules going to come out? I don't know. So if I was a betting woman, I would say we're not going to see the final rules until at least this fall. And then it's going to be some time after that before people are going to have access to it, because this would require a significant programming change on the servicer side and significant disclosure and other type of written information. And that stuff takes a long time. Now, the Department of Ed really wants it out. If you talk to the Department of Ed, you might hear them say, well, we want to have it available by this summer, or we want to have it available by the time payments resume this fall. And if they do it, more power to them. But as I said before, and I'm not being a Debbie Downer here, I'm just being pragmatic. The Department of Education has a lot of really big projects, and Congress has denied them additional funding to fulfill those projects. So I will be personally surprised, delighted, but surprised if this thing is in place by this fall. I will be delighted if we even see the final rules by this fall. So I'm again not trying to be a Debbie Downer, just trying to set expectations. All right. Let's see. I see any other questions? I do see people saying they were confused, and that means I didn't do my job very well. I mean, this stuff is pretty confusing. But if you want to post another question, I could take of something you'd like me to go over again. I'm happy to take a shot at it.
You did your job. There's just such a level of detail here that, of course, there are just so many confusing parts. I know.
The only other thing I'll add is, I do want to thank MEFA again for hosting this and for all the webinars they host. I will say, in Pat and I's experience, the borrowers that do get some sort of proactive education about these programs are much, much more successful. And I'd like, especially for public service loan forgiveness eligible employers, I mean, this is a real free benefit that they can offer to their employees. And Pat can verify for me, we work with a lot of borrowers that specifically look for jobs or looking to stay at jobs because they are PSLF eligible jobs. So if you are working for a PSLF eligible employer, I encourage you to encourage them to offer some sort of proactive education to their constituents. And it doesn't even have to cost them anything. It could be as simple as providing a link to either the Department of Ed's or our PSLF page. But it can be a real game changer. And again, it's a free benefit that these employers can offer, and it really makes a difference. So thank you, Julie and the rest of the MEFA team, for recognizing that and offering this to your audience.
Well, thank you. And we will continue to do that as things evolve as well. And thanks to you, Betsy. I see two questions, both about taxation. Do you think the taxing IDR forgiveness will go away forever? And what are the 4 states that say now they will tax the debt relief if we get it?
Okay, so I don't remember the 4 states that are left. The IDR forgiveness, so just as a recap for those that might not be aware, IDR forgiveness used to be taxable at the federal level, but Congress put a temporary moratorium on that through 2025. The fact that Congress even put a temporary moratorium on it gives me hope that they will extend it, permanently. So again, remember, I'm a failed pessimist, but if I was a betting woman, I would say there is a 65% chance that Congress will make that permanent. Now, as far as the 4 states that are still taxing the Biden-Harris debt relief, I honestly don't remember. Pat, do you remember? I think Indiana's one. Pennsylvania might be one of the Carolinas.
Massachusetts is not one.
Correct. I will say that somebody Googled it. I love the Google machine. I think California. So on this list is Arkansas, California, Indiana, Minnesota, Mississippi, North Carolina, Wisconsin. I know for a fact California, like Biden announced it on August 24th, and California started moving things on the 25th to get rid of it. I think Indiana, North Carolina, I think Wisconsin might still be in place, and I don't remember the 4th one. So, all right, well, things have gone quiet.
Well, thank you, Betsy. Thank you, Pat. And thank you, Stephanie and Sean, for being here as well. And thank you to everyone who participated. And yes, we will we'll have you back, Betsy, and we'll continue to educate us as things evolve. So.
All right. Well, have a good afternoon, everybody.
Thanks,
Thanks,
everyone.
Betsy. Thanks, Pat.